Monaco 64, home of alternative economics and contrarian views. This interview is being recorded on Thursday, May 12th, 2022. Today, I have the pleasure of speaking with Rob Berger. His YouTube channel is Rob Berger. He describes his channel as being dedicated to helping the viewers achieve financial freedom. His videos cover everything from getting out of debt to investing for the very first time. And I have to say, just before we started, Rob said, I was surprised that I contacted him, but I think his philosophy is similar to mine, even though the strategy might be a little different. He's not focused on precious metals, but recently I've seen a few videos about I bonds or inflation bonds in the US, and I saw Rob's last week, and his video is from about a month ago about inflation bonds, and we're going to talk about that. And this, of course, will be mainly for my US viewers, but it might interest people elsewhere. So Rob, welcome.
Thank you.
Thank you for accepting my invitation. So let's start right away. Maybe you could distinguish or differentiate I bonds from TIPS, you know, the Treasury invested protected bonds.
Sure. And there's a number of pretty significant differences. I mean, fundamentally, both are designed to protect an investor from the ravages of inflation. They do it in different ways. TIPS, as you probably know, the interest rate, not the yield, but the interest rate is fixed for the duration of the bond, but the principal amount adjusts based on inflation. With I bonds, it's sort of the opposite. The interest rate is what changes, and it's set every 6 months based on CPI. It adjusts in May and November, so it just adjusted. And on an annualized basis for I bonds, it's currently 9.62%, which is about the best return you can get on a risk-free investment today. I guess it barely nudges out inflation in the U.S., but it does, I guess, at the moment anyway. That's how they work, or the differences. But there's a bigger difference in some respects, and that is the TIPS trade on the secondary market, right? So you'll find them in an ETF, for example. I bonds do not. You will not find I bonds in an ETF or a mutual fund. You have to buy them direct from the government, and there's a limit to how much you can buy. It's $10,000 basically per Social Security number. You can also buy another $5,000 with a tax refund, and you get a paper bond, but that's the limit. So it takes a number of years. Of course, if you're married, both spouses can invest the $10,000, or a total of 15 if you include tax refunds. So depending on your portfolio and what you're trying to do, it can take some time to build up a position in I bonds. So that's, I think, for investors, that's probably the biggest difference between them. And then there's some limitations on liquidity. You can't sell an I bond for the first 12 months. If you sell before 5 years, you pay a 3-month penalty equal to 3 months of interest. So there's some liquidity things to not concerns, but limitations to factor in. But at least at a high level, those are the primary differences.
So is the 10,000 limit per Social Security, is that every tax year you can do that?
It is. And you can also buy it on behalf of a trust, which would have a different, it wouldn't have a Social Security number, would have what's called an EIN, but identification number. You can actually also buy them for a company. So if you have a small business, you could buy, you could create a Treasury. It's Treasury Direct is where you go to buy it, and you can create a Treasury Direct account on behalf of a company as well. So depending on your circumstances, you can increase the amount, but there's going to be a limit to how much you can purchase. But yeah, it is every year.
And how is the rate set? Could you go over that?
Sure. So there's two parts to the interest rate for an I bond. There's a fixed rate, that will stay the same for the duration of the bond. That's currently 0%. That is set again every May and November by the Treasury, Secretary of the Treasury. And, you know, the factors that go into that, I don't think are sort of officially disclosed, but certainly I got to believe that she's looking at yields on tips and other sort of somewhat comparable instruments, I would think, you know, and just the market. But in any event, so that's a fixed rate. It's currently 0%. And then the inflation, you simply add up the changes in CPI for the last 6 months. And then that's what's going to set the inflation rate. Again, that changes every 6 months. And it was, before May, it was on an annualized basis, 7.12%. As I'm sure all your viewers know, inflation has been going up. So it adjusted to an annualized 9.62% in May. And we'll know the November number. Well, each month we see the CPI changes month over month. So we can kind of add them up as we go. But by September, we'll know what the inflation rate will be set at for November.
I see. And right now, so if I were, if someone were to buy an I bond, they would get 9.6%.
On an annualized basis, 9.62%. Again, that would change in November.
Yeah.
And one thing to keep in mind is that although the inflation rates are announced in May and November, when the new rate will actually apply to the specific bond or bonds that an investor owns depends on the month they bought it. So it'll change based on the month you bought it every 6 months after. So, for example, a lot of folks bought bonds, I bonds in April, knowing that what the new rate was going to be in May. And that was a pretty good strategy, because if they bought it in April, they got 6 months of the old rate, annualized 7.12%. But they didn't lose out on the 9.62. They'll get that for 6 months as well. It'll just begin in month 7.
Oh, I see. And
So
then in
that
November,
confuses.
and then in November it switches to another 6 month rate.
Well, it confuses people because they think, well, if I buy in April, will I not get 6 months of 7.12%? Because the new rate's announced the next month, but you do get the full 6 months of whatever the rate is when you buy the bond. And then that concerns people, because then they think, well, wait a minute, if I'm stuck at 7.12% for 6 months starting in April, will I lose out on the 9.62 that started in May? No, you'll get that for 6 months as well. You're just sort of on a different schedule than the month in which it's actually announced. It gets a little confusing, but yeah. You basically get the rate that exists when you buy it for 6 months, and then you get every other rate that's announced for 6 months as well.
I see. So the 9.62, you start getting that in November, or does it compound together with the 6 point?
So it'll be now, the 9.62 was announced in May.
Yeah.
When it will kick in for a bond that you might own simply depends on what month you purchased it.
I see.
It may or may not kick in May. It might not kick in until August.
I see.
Right. But whenever it applies to the specific bond an investor owns, they will get that rate for the 6 months.
I see.
And then it'll adjust to whatever the next rate is.
I see. What about?
There are also I should mention, there are some tax advantages. You can defer taxes on the interest until you cash in the bond.
Oh yeah, that's what I was going to ask. So it's a tax is just normal income tax.
Yeah,
I see.
But you don't pay it. You can defer it until either the bond matures or you sell it.
I see. And I guess right now, with inflation being so high, even if you after 12 months, if you decide to sell the bonds, losing 3 month interest is not that bad compared to the returns you're getting in other investments, right?
Oh, absolutely. I mean, savings accounts in the U.S., the best one right now is maybe 125 basis points. I've seen one business account at 150 basis points. So, Yeah, I mean, even if you were to just keep this for a year, you would do significantly better. I mean, unless bank rates go through the roof between now and then, but that's, they've been moving up, but doing so very slowly.
Yeah, and here in the UK, we have something called the National Savings, and it's run by the government, guaranteed by the government, similar to the US Treasury. And we used to have bonds that were linked to the RPI, Retail Price Index, and the CPI, but now they've stopped it because I think a lot of the banks complained that wealthy individuals are putting a lot of money taking out of the bank. Do you see a danger of eventually the U.S. Treasury stopping these if inflation continues and people start piling into I bonds?
I don't see any sign of that at all. I mean, keep in mind, again, there's a limit to how much you can purchase. Number one. Number two, the fixed rate is 0. And I understand that inflation is high. But of course, unless inflation goes higher, I guess anything's possible. We're going to start comparing new, prices to already elevated prices. And so, the question is, when will inflation moderate? And the last thing I'll ever try to do is predict interest rates or inflation. I'll make a fool of myself if I try to do that. But I'm not, I think there's at least a good argument that, inflation could start to moderate a little bit. And I guess time will tell. But yeah, I mean, there's a limit to how much you can purchase on the I bonds. Tips are based on an auction, and so their yields were negative for a while. Now they're not, but they're not very high. So they've been we've had tips and I bonds since the 90s. I suppose anything's possible. There was a time when you could buy more I bonds. The purchase limit was higher at one point. I think it was 30,000 at one point, but I've seen no indication that there's any discussion of getting rid of them, and in fact, there's some discussion about raising the purchase limit.
Well, that would be good. And how come the tips? I know the tips are used by like big investment firms, hedge funds, and speculators. How come the tips don't seem to be a very good protection against inflation compared to I bonds?
Well, I think they are actually. I mean, the difference is, because tips are traded on the open market, when, there's a number of factors that affect their price, right? It's not just inflation, it's also interest rates. So if interest rates go up, as we all know, the value of bond goes down. And you see that in the tips market, at least in the short term. You don't see that in the I bond market because there is no I bond market, right? So, the way I look at tips is you could consider them like they're a treasury bond with an inflation insurance policy attached to them, right? And you pay for that policy based on the difference in the yield, right, between a tip and a comparable, a treasury with comparable maturity. And, the Fed has, you can look at it, I mean, it changes daily, and you can see that spread. And so, tips will, I think, in the long run, be a better deal than treasuries if inflation turns out to be higher than the market thinks it will be, right? Because what the market thinks inflation will be is reflected in the spread, right, between tips and treasuries. So, and the market's always wrong, right? They're never exactly right. It's just, but if inflation turned out to be higher than that spread, then the tip would have paid off. That insurance policy, it would have been a good thing to have bought. And if inflation turns out to be lower than the market expects, then you've kind of wasted your money buying that inflation protection. You'd just been better off with treasuries. And so I think a lot of investors, myself included, have both.
Yeah.
Right. If I don't think I'm good at predicting whether the market's right or wrong about inflation, and I don't, I kind of just cover my bases.
Yeah. And the tip, like the 10-year treasury, I know it's dropped below 3%, but to make it easy, right now it's 3% yield. So if you buy a 10-year tip, do you get the 3% plus what the market thinks inflation? How does that work?
Well, the yield on a tip is going to be lower than the same duration treasury, right?
Okay.
Because you're getting that inflation protection, right? Unlike a treasury, the principal balance of a tip's going to go up with inflation.
Oh, I see.
You'll get that elevated amount, that increased
Also,
amount.
the principal goes up in the tip when the interest rates go up as well. So that's how.
Well, it goes. They go up based on inflation.
Oh, I see. Is that published every month or?
Yeah. Well, inflation is. I think that I'm trying to remember how often the tips adjust. Off the top of my head, I want to say it's every 6 months, but I may have that wrong.
I see.
Yeah. Yeah.
And I know you don't like to predict inflation and interest rates, and I know it's difficult, but how do you think the Fed is behind the curve, or do you think they're doing enough to rein in inflation?
Well, it's a common view that they came to this, they started moving too late. That's sort of the common view. The thing is, had they moved early and actually fought off inflation, but at the cost of slower growth and higher unemployment, everyone would have said they moved too soon. and we wouldn't have known what would have happened had they, done what they've done.
Yeah.
So I think it's easy to look at it and say, well, yeah, look at inflation. They move too slowly. I think time will tell. I still think there's a big question about what's causing inflation. My own personal view is it's a whole bunch of things, from the situation in Ukraine and energy to supply chain issues to, certainly fiscal and monetary policy in the US. I personally, I would probably put more emphasis on monetary policy, and we're still pumping money into the economy, not in the same way we were, during the more difficult times with with COVID. But just as an example, individuals with federal student loans in the U.S. still don't have to make a payment. They haven't had to make a payment, since COVID, and they don't have to make a payment until August. And there's talk about extending that and forgiving a certain amount of their debt, all of which just gives them more money to spend. And the amount that Americans have saved is higher than it was, say, pre-pandemic. So, unemployment is extremely low. The workforce participation rate is not great, though, in the U.S., but unemployment is low. So certainly there's a lot of money to be spent. And I think all of these factors sort of have come together to create, the highest inflation in 40 years in the U.S. But how they resolve themselves will be the interesting question. And when will supply chain normalize? And I'm certainly not an expert in supply chain issues, but it's a question. So did the Fed move late? I would say they probably did a little bit, but it's a hard thing. I think it's a hard thing to get right. And what we don't know is what would have happened had they moved earlier. Maybe things would have, maybe inflation wouldn't have been as high and things would have worked out fine. Then again, maybe we would have created other problems. So that's sort of a long way. That's a long, convoluted non-answer to your question.
Yeah, and I see that your channel is dedicated to helping people with financial freedom. So what do you think are the most important points about becoming financially independent?
Yeah, great question. Well, the thing is it's pretty simple, but not easy, in my view. As an initial matter, you have to spend less than you make. And I know that's like, call me Captain Obvious, but that's unless you win the lottery or inherit a lot of money or invent Facebook, you got to spend less than you make. And what I think for most investors, myself included, the best way to build wealth long-term is to take the difference and put it in low-cost index funds. Now I have other investments. I've invested in real estate over the years. I do own some individual stocks. But I think the lion's share of ones, I call it the freedom fund, but your wealth should be in low cost index funds. I think that's going to be, it's going to help you create the kind of portfolio that I think you can stick with. Certainly you should stick with no matter what. So like even as the market's gone down this year, inflation's up, I haven't sold anything. I've made no changes to my portfolio. And I didn't make any changes during the Great Recession. I didn't make any changes during the tech bubble. So, it can be a little challenging to sort of live through your first big bear market. But I've yet to talk to anyone who stuck with a simple, low-cost investment plan through a couple of economic cycles, and come out to that and said, "Boy, I really regret sticking to that plan. That was a big mistake." I've never heard anyone say that. I've heard plenty of people come to me and say, "Yeah, in the Great Recession, I got scared and I sold out, and it was the biggest mistake I ever made." So it's fairly straightforward. I'm not suggesting it's always easy. In my channel, we get into a lot of more detail. How much should you save? And a lot of discussion around what do you do once you retire? In the US, there's a lot of complexity around retirement mainly because of tax laws are complicated. But you've got questions about how much can you spend in retirement each year without going broke? How should you invest your money during retirement? How do you take your money out, and where do you take it from? In the US, it's not uncommon for a couple to have, because of taxes, 6, 8, 10 different investment accounts with different tax implications. So you achieve financial freedom, and then your real work begins, figuring out how to deal with it in retirement.
And I haven't really looked. I've watched some of your videos, but just wanted to ask you your view of precious metals, if you have any opinion on it.
Yeah, I don't. I see I have a couple back here. I don't. This is a bicentennial proof set. This probably wouldn't be. I'm not sure this would qualify as precious metals. I actually looked up the value of this. This is from 1976. You can buy this on eBay, the whole set, for like $13. I'm not a precious metal investor. And for the most part, I never have been. I mean, I've owned a little silver from time to time. And my reasons are mainly because long-term, there's really, I think, maybe two reasons. One is long-term, they've not performed well. I mean, if you just look at gold and silver long-term, certainly they keep up with inflation. So, if you ask me what I'd rather hold over 100 years, gold or the US dollar, that's an easy answer. But if you ask me, well, would you prefer to hold gold or stocks? Well, to me, that's an easy answer too. I mean, they've outperformed, stocks have outperformed precious metals, certainly over long terms. I mean, I guess if you go back into the 70s, you have a number of years where gold, obviously, following Nixon and all of that, did very well, but long term, it just hasn't kept up. And by the way, my father was in the gold business. I mean, he's passed away now, but and he was in the gold business in the 70s, and I remember the price of gold going through the roof. But he wasn't an investor. He sold, he sold gold jewelry. Was his business. So I kind of grew up with precious metals, but for me, they haven't performed well, and I'm just generally not one to put a lot of capital in a non-productive asset. I know some people allocate 5% or something to precious metals. And I can't argue with that approach. It's just not what I've done.
Well, I know what you mean, but since around 2002 or beginning of the century, gold actually has outperformed the S&P plus dividends. So I'm not trying to just my opinion, but It's good. I would say that I got discouraged back in 2002 because, you had the dot-com bubble burst, and my pension dropped quite a bit, and I wanted to find an alternative. So I was one of those persons who thought, I don't like this. Instead of sticking with it, I stopped paying into that private pension. But I mean, in terms of the US stock market, it would have been good to keep that. But if I look at the FTSE 100 index here in the UK, back in late 1999, 2000, it was around 7,000. And today it's still at 7,000. Mm-hmm. So I guess it depends also where you are. But anything.
Well, one perspective there, particularly for the U.S., if you're right, if you say invested a lump sum in 2000, and you fast forward 22 years, and I'm looking at a chart now on my screen, it shows gold outperforming.
Yeah.
But you will get a different result for those that are still accumulating. If you, instead of investing a lump sum, which is not how most people invest, right? I mean, we invest in the US, you put a little bit of money in your 401k every paycheck, you invest in an IRA every month, your dollar cost averaging.
Yeah.
And if you look at the data that way, you'll see different results depending on what period of time, because your dollar cost averaging during the tech bubble when stocks are really low, you're doing the same thing during the Great Recession when stocks were really low. You're buying cheap, in other words. So just another perspective, something to consider as you're sort of evaluating the historical data.
Great. Any last words to the viewers about I-bonds and things in general?
Well, I think in the U.S., I-bonds are a great investment right now. My wife and I have put in as much as we can, and at least while the inflation rate is as high as it is, we'll continue to do that. So that I think it's probably the best risk-adjusted investment that is available today. The only other thing I would say is that, particularly when inflation is high like it is now, and I lived through, I used to get 16% on a certificate of deposit. This was in 1982. And I remember I would always do a 6-month CD term, which was the shortest. And I've had people ask me, well, 16%, I mean, why didn't you lock that in for 5 years? And the answer was, we were frightened that interest rates were going to go up. Right.
Yeah.
And so
I remember the early 80s, and most people thought that it was going to keep going. Yeah.
So it doesn't really matter what the interest rate is. It can be 16% and you can still be afraid it's going to go higher. And so my approach to investing generally is to ignore any, prediction. And if you can get on CNBC or anywhere and you're going to get 1,000 predictions, but ignore economic predictions, ignore predictions about inflation, at least when it comes to actually having an investment plan and executing it. So if you have a well-diversified portfolio that's low cost, I think generally should be mostly stocks, but some fixed income. I think it's going to serve folks well long-term. If you try to invest based on your prediction of where inflation is going or where interest rates are going, I think that's a very, very difficult thing to get right over 20, 30, 40, 50 years as an investor.
Great. Rob, thank you very much for accepting my invitation, and I wish you all the best.
Appreciate it. Thank you.
You're welcome.